Welcome back. At the break, I got a phone call from IBM, I believe, and they asked me to review one of the problems from Chapter 31. So what I thought I would do is we'll start with that, and because I think it should not take long. And if the message was relayed correctly, the question is, it's example number 5 in Chapter 31, which is an example of sunk costs. So if you will go to that, I will try to explain the rationale behind what I think the solution should be. If you would zero in on this, bring it, yeah, too much. Bring it back a little bit. Okay, that's good right there. So to understand what's going on in the example, it's an example of sunk costs. And the way the story goes like this. You have made an investment in year 1. It's now the beginning of year 2. So it's January 1st, year 2. And you have to make a decision. Do I continue on with Project A, in which case I've already lost a whole bunch of money? So do I continue on with A, or do I change, and rather than do Project A, which obviously in the end is going to be a total dog, do I switch and do Project B, which in the end is going to make me $500,000? That makes sense, everybody? Now, the key thing is the marginal decision-making idea. And the marginal decision-making is what? That what we compare is the extra benefit to the extra cost. So we ignore what went on in period 1. At the beginning of period 2, all we're comparing is the extra revenues to the extra cash outflows. And so if we do this, we see Project A has $300,000 in both years 2 and 3 for Project A, where Project B has $300,000 and $200,000. And so from this point forward, if we do Project A, we get $600,000. If we do Project B, we get $500,000. Would you rather have $600,000 or $500,000? Not a hard decision, right? The tricky part is that since year 1 is part of the past, it's a sunk cost and does not get included in the decision making, but it does get included in the accounting. Okay, so the final, this is not meant to be misleading, because in total, that's what accounting does. It adds up everything and says, how did we do, right? In the end, Project A was a dog project. But from the beginning of year 2 forward, Project A was better than Project B on a extra benefit compared to extra cost basis. Does that make sense? So the key to understanding that again is you compare the extra benefit to the extra cost. And, you know, it's likely you'll see a question or two like that on the final exam. Questions? Now, hopefully, those of you at IBM who asked for this, if this is not the question you want it done, please let me know. If this is the question that you want it done and you disagree or you want to make a comment, please call in and we'll try to receive that question. I mean, I'd like to do it on the air. We've had some difficulty with technology, but you know, if you please try to call in if you can. Okay. The next topic is activity-based costing. We want to go through a simple example of activity-based costing. I am in Chapter 39, and what I found in the past is that it makes most sense to jump right to an example. So I'm on page 39-3. So while you're opening the page 39-3, let me give you the basic idea of what's going on. Generally speaking, historically, 20, 30 years ago, most cost systems had this big blob of overhead. So this is all overhead right here. And then this big blob of overhead then gets allocated to things. And we could have a one-stage allocation mechanism or two-stage allocation mechanism. A one-stage would be where the overhead was allocated directly to the final products. A two-stage would be where the overhead was allocated to the departments, and then from the departments, costs were then allocated to the individual products. That would be a two-stage allocation mechanism. Well, the problems with two-stage are the same as the problems with one-stage, except we have twice as many of them, so I'm going to ignore two-stage for now, but you should understand that this does get more complex than what we're doing here. So if we allocate using a one-stage or a single-stage system, then the overhead is going to be allocated down to products A, B, C in some way. And the way that historically it was done is that firms use some variant off of direct labor. And that could be either direct labor dollars or direct labor units. Hours would be the units in this case. And they would then use these hours as what we call the cost driver. And then we then allocate to A, to B, and to C this whole blob of overhead based on how many direct labor hours A, B, and C in fact utilized, or how many hours it took to produce these goods. Now, the problem with that system was what? Why is this not necessarily a good system?
Because some processes have mechanized operations where there aren't a whole lot of direct labor hours or dollars involved.
It's often the case that overhead is not directly related to direct labor hours. It could be the case that the product that uses relatively the smallest amount of direct labor could use the most amount of overhead, because the overhead may deal with the robotics, for instance, to produce that particular product. So it's not necessarily the case that direct labor hours and overhead are linked. So then what happened over time was accountants and economists and actually production managers start to look at this overhead blob and parcel out various portions of it. And these portions became what are known as cost pools. And then what happened was these individuals started looking at, okay, given that we have this cost pool, is there some cost driver that will link this cost pool to products A, B, and C? Now, for instance, suppose the particular cost pool is the cost to purchase materials, the cost to purchase inventory. So it's purchasing. That's this particular cost pool. Now, what does this cost pool include? What are the costs in the cost of purchasing?
Salary of the purchasing manager.
Salary. What else?
Shipping charges to get the product here.
The shipping costs usually are included in the cost of inventory, not the cost of ordering. The cost for utilities, for the phone, for the equipment, the computers, things like that. Does that make sense? But most of the cost is going to be what? Probably salary. Does that make sense? Now, that's just the cost to order. That's not the cost of the materials themselves. It's just the cost to order. Someone has to physically contact all those vendors and then make sure that what came in was, in fact, what should have come in. We ordered a blue one, we got a blue one, right? It's 12 inches high. In fact, it is 12 inches high. Not 14, not 11. Neither of those two fit, right? That's all part of the cost of purchasing. Very labor intensive. Now, so the next question became, okay, so we've isolated this cost pool. How do we link this cost pool to products A, B, and C? So given that we're talking about purchasing, what is it that purchasing departments do that we can call an activity that links purchasing to products A, B, and C?
Writing purchase orders related to A, B, and C.
Generally speaking, one thing that happens here is they write purchase orders, or POs, right? So if product A takes 5 POs, product B takes 1 PO, and product C takes 10 POs, right? Because product C has a large number of parts. Now, how does that suggest that we should then allocate purchasing? Relatively more should go to what? C. Relatively less goes to B, and A's in the middle someplace. So what would happen is they would total up the total number of purchase orders, divide that total number into the total cost, and get some cost to produce each purchase order. And you would do it in a standard costing kind of a scenario. You use last year's information to predict what this year's will be. And so then what you would get is some dollar amount per purchase order, and then you would allocate this overhead to products A, B, and C based on the number of purchase orders that each one caused the firm to write to really get the materials in. Does that make sense, everybody? Now, activity-based costing is the idea that it's activities that cause what? That cause cost. Now, inherent in that assumption is what?
You have activities.
Who performs activities? People, right? So inherent in this activity-based costing idea is that it's the actions of people that cause cost. Does that make sense so far? Let's take it one step further. We have all these activities, and they all cause cost. Now, which are the good activities, which are the bad activities? Some of these activities create value directly, right? Other of these activities create cost, but they do not create value. So now what's the goal then if you're using activity-based costing? What are you going to try to do? Get rid of the activities that don't create value. Now, a trivial, and I mean extremely trivial example of this is, assume that we have a production process where we have station A, station B, and station C. So what happens is, the raw material comes in, it goes into production station A, comes out A, and so we have this raw material that just came out, got transformed. Now somebody picks up this material and carries it over to where? To B, right? And so now the material is sitting at B. So the first activity was to put the raw materials into process A. Did process A create value? Of course it did, right? Or else we wouldn't be doing it. Once it came through process A, did the movement from station A to station B cause value? No. Total waste of time, right? So the first activity created value. Second activity did not create value. So what do? You eliminate the move. How do you do that? You move the equipment closer, right? So what happens is it comes off A, and it dumps right onto the belt for station B. Does that make sense? Now again, this is a very simplistic idea of how to make money in manufacturing, right? And I am not for a second suggesting that Boyle knows even squat about manufacturing, right? But hopefully it gets the point across that these value-added activities can be separated out from non-value-added activities, and the goal then would be to use activity-based management to try to change your production process once you've done an analysis of what creates value and what does not. Questions about that? So what we're going to here is, first, the key idea being that it's activities that create both cost and value. The second thing is that, if we go back to the picture we were talking about before, that if we isolate out various cost pools, what do we have to do? Every time we have a cost pool, what do we have to figure out? how to allocate it, how to link it to the either departments or to the products in question. So critical in this analysis, right, in activity-based costing analysis. So if you're going to do activity-based costing analysis, the first thing you need to do is think about cost pools. But cost pools are easy to segregate and don't do a darn bit of good. So you need to jointly think about a cost pool and some link. And that link's called what?
Cost driver.
Cost driver. So the magic here is not to be able to isolate the cost pool, but to be able to isolate the cost pool in conjunction with the cost driver. And so you can't do one without the other, but you have to start someplace, right? And usually you start isolating a cost pool and trying to figure out, okay, how do we link it? But if you can't link it, go back to the drawing board. Because without a cost driver, the best cost pool in the world doesn't do a darn bit of good. Questions? Okay.
This method works when you're doing lots of widgets.
Say it again.
This method works when you're making like lots of the same thing, and it's a small thing that you make a lot of.
This method can work no matter what, whether you're making large lots or small lots. Is that what you're asking?
Yeah.
Okay.
Because if you're doing a few projects, you can like charge time to a certain project number, and then at the end of the week, you know how many people have worked on that associated project. And if you're doing a few large projects like that, then you can get specifically what your costs have been.
You can get a reasonable estimate. Right. Agreed.
Reasonable, you get exactly.
Okay. Maybe. Right. But how much time does the president spend on that product? So I say reasonable, but the point is taken. I certainly agree. Okay. Let's go to an example. Question? I think an example makes this stuff a little bit cleaner, because the example is, I think, fairly straightforward. So I'm in example 2, page 39.3. So in this particular example, we have a big blob of overhead. And the total blob of overhead totals how much? $220,000. It's a big blob of overhead. Right? And the big blob can be separated out. Now, again, the trick to doing activity-based costing is to try to figure out how to separate out the various cost pools. Now, in this particular example, I list them as 4 different cost pools. So I kind of did the work for you, right? To make it very, very straightforward. So in this case, the full 220 can be broken into 4 different cost pools. One for setup, right? And setup in this case at a total expected cost of $60,000. Let's wait a second here. What do we mean by setup? What the heck is setup cost?
Setting up the machines.
Setting up the machines.
How much scrap and material, or how much scrap is generated, and how much labor.
It has something to do with scrap. Suppose.
Oh, this would be overhead, so that would be.
Again, suppose we have an A, B, C, 3 stations in this particular production run, right?
If it's overhead, it would be the amount of dollars that could be produced if the machine was running, not running setup.
Could be a lot of things, right? But setup cost usually involves, we use machines A or stations A, B, and C to produce many different products, right? A through Z. And we do that in what are called runs. What's a run?
A lot.
It's a lot. It is a lot. Sometimes it's a lot, sometimes it's a little, right? But it simply means the number of units. The number of units cubed, right? So one run might be 500 units, might be 20 units, might be 10 million units. But that's one run. Okay? Does that make sense? Now, so we might do a run of A, B, C, go back into another run of A, then D, E, F, and then so what's happening is you're using these 3 machines to make 26 different products. Every time you go to create a new product, what do you have to do?
set up machines to make that product?
You have to set up the machines. You have to disassemble this a little bit to change the diameter of the tools on it. To change this one a little bit, you change this one a little bit. So in terms of setup, what's the primary cost in terms of setup?
Labor.
Labor. Labor hours, labor dollars, something like that. Does that make sense to everybody? I mean, if you don't understand what these things are, in my opinion, it's hard to visualize what's going on. Now, so we have this setup cost, and the setup cost is each time we do another run, we have to rearrange the machine somehow, right? Putting different cogs on and stuff like that. Okay. So the next cost pool is ordering costs. Now, what are ordering costs again? It's purchasing. We talked about moments ago in this class. Another one, okay, this ordering was how much? It was 45. Then there is machine. A machine costs 90,000. Now, where'd that come from? How do you get 90,000?
Maintenance, repair, machines.
Depreciation on the machines, maintenance on the machines, stuff like that. Right? Okay, the last thing is power, electricity. And that's not much, 25. Now, luckily, the cost driver is listed for each one of these cost pools. Now, for setups, what's the cost driver?
Each setup.
Number of setups. Now, so then what you do is you take total cost of setups, divide through by the total number of setups you expect to happen for all products. In this case, there's only 2, but A through Z and other examples. And that gives you some cost, an average cost per setup. And then you take that average cost per setup, and then you use that to then do this product. Now wait a second. Could some products require 2 setups? The answer is sure. What might be the case is you take this blob, right, of raw material, you run it through A, B, and C, and you have to go back and readjust A and B and run it through A and B again to get the final product. So under those conditions, it would take 2 setups, right? One through all 3 machines, the second line through A and B. So theoretically, you could take 2 setups to do a particular. Or you could look at each machine as a different setup, theoretically. So you could, setups could be defined in different ways. Okay.
How about time that it takes to set up?
Well, you could use that. You could use direct labor hours, or because time and money, right? Einstein's favorite, time is money, right? Einstein discovered that. But yeah, you could do it based on time, but it's time and activity. No, the cost drivers are activities, and so the activity is setting the lineup, right? Activity-based costing. For ordering, the activity is what?
Professor Bond, before you get off of setup, when you said you divide by the total, you divide by just the 60,000?
So, okay, in the example here, we take the 60,000, which is total setup cost, divide through by the total number of setups we expect to see, which is 300. 300 and 60,000 is 200. So your estimate on average is it takes you $200 per setup. In this particular example. Questions?
So what do you do, those are all expected numbers, what do you do at the end of the year when your actual numbers didn't meet your expected numbers?
Well, you adjust your expectations.
So you can go back and do that?
Okay, would you do it retrospectively? The answer is no. And what you might do is every quarter you might readjust, you might recalibrate so the next quarter is better. Or you might be able to do it every month.
Yeah.
I mean, the whole point is to get this as accurate as you can. Right, so your point's a good one, and the second question is, does it make sense to go back and re-cost the stuff you already did? And the answer probably is no.
Yeah.
But it's very important to then, from that point forward, make it as accurate as you can. Everybody with me so far? Remember about this activity crap, right? This cost driver stuff. Again, it's not that difficult in terms of the algebra. It's very simple, very straightforward. The reason it gets tricky is why? Because trying to figure out that cost driver is extremely difficult. Isolating cost pools, no problem. Anyone can isolate, anyone can add stuff up, right? But trying to figure out a way to link that stuff that you just added up, that cost pool, to the product, to the production of the products involved, is extremely tricky.
Yeah, but the first one, I would have thought time to set up something is important, because product A could take you 3 times as much as product B, so if you do it by number of setups, then you're missing how long it takes. Maybe it's more complicated, you need more things in there.
I could not agree more. But you're looking for something that's simple and easy to apply as well, right? So keeping track of time per setup per product might give you a more accurate but a more onerous process to do it, and it might be worth it. You know, so in this case, maybe it's better to just take the total.
And it's worth it when you can figure out how to make a profit out of that, knowing that cost.
Well, okay, save your questions for the first example. Okay. So now here's our mission. We have 2 products. So we have this total amount of cost, the 220. We have 2 products, product 125 and product 128. And so the question becomes, how much does it cost? How much does it cost to produce product 125? How much does it cost to produce product 128? Now, below there, right, and kind of a third of the way down, what we look at are the various direct costs. So the direct materials for product 125 is $750. For product 128 is $850. I'll just go down 125 for now. So direct labor materials is $750. Direct labor cost, which is 100 hours, is $600. Units completed, that's units completed per what? Per run is 100. Number of setups in the run is 1. Number of orders, right, number of purchase orders is 4. The number of machine hours used is 20. And the number of kilowatts used is 20 as well. Now,
is that per period or per run?
Per run.
So would there be a line for runs in a period? Like, so they fall into that there should be a period.
Well, there should be. We're going to assume 1 run per period. Just again, this is.
Just want to make sure.
Yep. Now, at the bottom of the page, we're looking at the first question is if we have a direct labor cost driver, and only a direct labor cost driver, how much does it cost? So, quickly going through, right, for 128, what we have are raw materials. The raw material, the direct costs are the direct material and direct labor, 750, 650, 1350, right? I show it as 2 different things. And then overhead, how do we get overhead? How do we get overhead in this example?
Figure out how much the total. We know the total. We know how many direct labor hours that were spent total.
Okay, so $220,000 is total estimated cost. What's the total number of direct labor hours? It's estimated.
So it's 4,000.
So it's 4,000. So we divide 220 by 4, and what do we get?
$55.
$55 per direct labor hour. How many hours are there?
100 for each of them.
Right, so it's 100 direct labor hours. So 100 times 55 is how much? $5,500. So total cost to produce this item is $68.50. How many units were produced? 100. What did it cost per product? Yawn me through that one, please.
68.
68. Oh, thirsty. Oh dear. Okay. Now this is actually 125, right? 128 The raw material cost is $14.50. Same amount of overhead, because they each use 100 hours, 5,500. Therefore, this totals to $69.50. How many units get made of 128?
50.
They only produce 100 units per run. So we're dividing by 50, excuse me, they only do 50 per run. Therefore, the cost is what?
139.
139. That's 139 per unit, right? Does that make sense?
Where did the 4,000 come from? Is this just
The 4,000 it's listed below job 127, 128. It's basically given to you in the problem.
Okay.
So
they made more products than just these two in the period?
Yes.
Okay.
And all we're costing is 2 of the men. Questions? Now, next time, let's do still one cost driver, but instead of doing direct labor hours, let's do machine hours. And this appears on the top of page 39-4. So we have 125 and 128. And this is for machine hours. We have direct cost of $13.50 and $14.50 for 128. Now, if we use machine hours to allocate overhead, how do we allocate overhead? Total cost of overhead is how much? 220,000. What's the total number of machine hours? 18,000. Right? That equals what? 1222? Per what? For machine hours. Right? Now, how many machine hours does Project 125 use?
20.
It uses 20. 20 times 1222 is what?
244.
44. Product 128 uses how many?
36.
Uses 36 machine hours times 22 times 12 rather. 36 what was this, 400 something?
440.
440. Now we add up our total cost. 4, 9, 5, 1594. Here we add up 908, 1890. That was a very good year, incidentally. Product 125, we produced 100 of them, right? So the cost per unit is how much? 1594. Over here we produced 50 of them. So the cost is 37.8, 37.8, give or take. Now here's my question. Using direct labor hours, the cost was $68.50 for item 125. Using machine hours, the cost is $15.94. Which is more accurate? Which is better? Do you see the problem? Now think about it. You've done your costs in 2 different ways, and you're trying to figure out what price should I charge? Do your cost estimates affect what price you're going to charge?
Sure.
Answer sure, because I mean there's some market for these things, right? There's some market price, but you might be able to charge less than the market and gain market share, depending upon if you know what your cost is, or more specifically, if your cost is below their cost. However, you might think your cost is below their cost, when in fact it is not, and end up selling something at a price that actually is under your real cost. You just couldn't measure it. Does that make sense? I mean, I hope this graphic right here clues you into what we said earlier in this class, which was there's not a firm in the world that knows what it costs to produce a product. Because what's going on here is the allocation mechanism is going to determine the total cost to produce. And the allocation mechanism at some point has to become arbitrary.
When I was reading the case, this thought popped up to me that
This is the destined case.
Yeah.
Okay.
But like, does it really matter what method you use if your net profit, your net income at the end of the year is the same? Because like you're still selling, you're selling 26 different products, and some of them are going to make more money than others.
Yep.
It just doesn't seem like it particularly matters where you put the overhead.
Okay. Does everyone understand that question? Let me put the question a different way. If you change from their old system, call it the traditional system, to the activity-based costing system, so you're organizing costs in different ways. Does total cost change? Does total cost of production change? And the answer is no. So the question is, look, if total cost isn't going to change, why do we bother doing this? And the answer is because relative cost changes. What happens in the destined case is that with one of their products, they are estimating their cost to produce that product. And they're estimating much lower than it actually costs, it turns out, in the end. So they think they have a cost of $50. Therefore, they're selling this thing at $70. I'm making these numbers up, okay, just so you're not looking for the actual numbers. And what they're finding is that as they raise their price, none of their they're able to raise their price and keep their market share. Now the reason is why?
Because it actually costs more than that.
Because their competitors have figured out it costs $100. When this company's charging $70, they're actually losing money. And as they go from 70 to 75, right, they're able to hold their market share because no one else will meet their price. So they can keep, in the case, they can keep increasing price. Conversely, because they've adjusted, like they're costing one thing with too little, therefore they're doing what? Costing something else much too high. Now, if you're costing some other good way too high, what do you do with that product?
You're selling it too high.
Well, if you're not making money on the product, what do? You stop making it, right? And so if you then get rid of the product where you think you're not making a profit, does this make sense? Mm-hmm. And so, does the total cost change? Your point's exactly right. Total costs do not change just because you change accounting systems. But hopefully the information that has strategic intent, which includes pricing, it includes cost basis actions, right? Strategic actions relative to competitors, you get better information for decision making in the relative, comparing one product to another product is the rationale for doing this.
I have two questions. The first is, if you use all four drivers to determine these two jobs, do you have to apply the same four drivers for the rest of the jobs you do in that time period?
Well, that's the key, right? The key is that whatever the cost driver is, it works for every product. In other words, all the products you have to have the same cost driver for all the products. Every time you do this, that cost driver has to be valid. And that's what's tricky. Because some cost drivers may work for products A, B, and C, but don't work for D, E, F, G, H to Z, right? And what you need is a systematic way to link this cost pool to every product that uses those costs. Does that make sense?
Yes.
So the answer to your question, the short answer is yes. Okay. So, back to the example just for a second. So we have two different cost estimates. And I'll keep track of these two estimates. On this page. So we have 125 and 128. We have direct labor hours. We have machine hours. And now we're going to have all four. So direct labor, 6850. 139. This was 1594. This was 3780. So now with all four, we'll compare all four in just a second. So we're comparing all four. So we have 125 and 128. We have direct costs, call it DC for direct costs. Direct costs are $13.50 for 125. They are $14.50 for 128. But now we have 4 different overheads that we have to allocate. One overhead for setup, one overhead for purchasing, one overhead for machines, and one overhead for power, kilowatt hours. So what we then do is we have to go over here and figure out the cost per activity per cost driver. And we go back to the basic information. For setups, right, we have a $60,000 setup divided by 300 setups gives us $200 per setup. Does that make sense, everybody? And we do that for the other three of these particular cost drivers. And what we end up with is that since we have one setup, the cost of 128, the setup cost is 200. There are 4 purchase orders. Each one costs $10, so that's 40. Machine hours turn out to be 100, and kilowatt hours turn out to be 10. So we add all this crap up, and we get 17. Oh, excuse me, we don't get 17. We get 4,700. We divide through. What am I doing? 1,700. Divide through by 100 units and get $17 per unit. Does that make sense, everybody?
On the above it, there the 2 driver example.
Yes.
How did you break up your 130,000 and 90,000?
Arbitrarily.
Yeah. Okay.
I just put some here and some there.
Yeah.
Okay, and I forget how I can go back and figure it out, but it's not important. I mean, you can probably figure it out just by playing with numbers. Okay. Questions so far?
Yeah.
Kelsey?
Are you only using the cost drivers for the allocation of the overhead? You're not taking into account any other kind of overhead, like depreciation?
Well, again, we go back to the beginning here, and total overhead for this company is 220.
Mm-hmm.
We broke that full 220 into 4 different cost pools.
So overhead's in there.
Everything's in there, right? Mm-hmm. So basically, what we've done is we've parsed out every piece of overhead that we were able to calculate.
Okay.
Does that make sense?
Mm-hmm.
Okay. So the total then for do the same process for item 138, we get a cost of 38. Questions? Okay, going back to our table here. The cost, if we use 4 cost drivers, is 17 for that, 38 for 128. Now, hopefully it makes sense here that if you're costing and your costs are very off, in this case products 128 and 125 are going to be relatively costed much too high, which means some other products are going to be costed relatively too low, which is going to make creating a pricing strategy a true nightmare, because you're trying to figure out, 1, should we produce these items? 2, should we sell them at what price? Should we meet our competitor's price? Should we sell a little bit above or a little bit below? But then again, strategically, that depends upon what your costs are. Now, item number 2 is that as arbitrary as direct labor hours is, machine hours is equally arbitrary. But notice, now can we all agree that using 4 cost drivers probably gives us a better estimate? How about if we lose 200 cost drivers? Will that give us an even better estimate?
Yeah.
The answer probably is yes. So most firms who use activity-based costing, how many cost drivers do they use? Do they use 4 or do they use 200? What do you think?
Closer to 4.
And the answer is about 10. Of those two choices, the answer is 10.
Yeah.
And the reason is why? Because 4 is nice and simple, easy to keep track of, but not as accurate. 200 is much more accurate, but much harder to keep track of, much harder to understand, and much more expensive to do the administration on. So what most firms have done, they've isolated down, right? They think that if we go to 10 cost drivers, we get 98% accuracy. We go to 200 cost drivers, we get 99% accuracy. So 10 cost drivers, easier to handle, easier to understand, everyone in the organization understands a little bit better, is much better than jumping way up for a small amount of extra accuracy. Does that make sense? Okay. Now, the other thing is that fortuitously, direct labor hours give us a very good estimate of cost. Right? But you would never know that unless you did what? Unless you, in fact, went through the whole activity of doing the activity-based costing system. Questions? Okay. Any questions about activity-based costing? Does that stuff make sense? Now, let's talk about destined brass. Should you choose to attack it? Give you a couple hints on destined. Job number 1 is to go and create an activity-based costing system. So, previously there was traditional costing, and your job is to create activity-based costing. Does that make sense, everybody? So you have to go through the case and figure out how. Right, the first thing you got to figure out is what are the cost pools. It's kind of straightforward, but a little tricky. It's kind of straightforward to figure it out, but getting the cost takes a little bit of time. And 2, what are the cost drivers? Then you got to figure out what the cost is per driver based on the cost pools. Then you have to allocate these costs to the three products in question. Questions about that? Okay. The second thing, and the thing that then separates the superstars from the rabble, right, is how does doing this give you better information, right? In other words, what's the whole point? So strategically, from a strategy perspective, why did you do that? How does it help you? What does it suggest that you do in the future? Those kinds of questions. Now here's what I expect. If you're going to do this destined brass case, okay, completely optional. 1, I'd like to see a statement of the problem. Call it a half page. 2, I'd like to see an executive summary. Call out a half page. And then I'd like you to support your summary with some analysis. And this analysis could be simply the Excel spreadsheet with a description of how you got it or something along those lines, right? The analysis of how you got your activity-based costing estimates. Does that make sense to everybody? Now, the summary, the executive summary, is where you describe why your analysis is making this company a better company, which is the strategic, what's the point stuff. That's the executive summary kind of thing. Questions? Does that make sense?
How do you want to send this in? Email it to?
Email it to Stacy.
Is it okay if we email a Word document in an Excel sheet, or do you want it like in one?
That ends up being a pain in the neck. It would be better if you did it all in Excel, or you did it all in Word, just to make it easier on the. I mean, I know from having received these things that keeping track of two documents is a pain in the neck. So, I mean, if you create a spreadsheet, you can either import it into Word and set the Word file, or you can write in you can write in Excel, just send the Excel file. And either way is fine. If you have to send two, send two. But I know Stacy, since I would prefer one document, Stacy will prefer one document as well.
It's not going to hurt us if you don't do it.
Doesn't hurt you at all. It can only help. But it may not help much unless you do a reasonable job on the analysis. Okay? Alright. Questions so far?
I don't know where one figure comes from this and Brad.
Sure.
In one of the tables in Exhibit 4, they're listing material-related overhead and the overhead absorption rate. And I see that in the numerator they have $220,000, which is the material-related overhead. In the denominator they have $458,000. Where does that figure come from?
That's your job.
Okay.
To try to figure that stuff out. I mean, and that's what's tricky about it. You have to interpret the information in a reasonable way, which is part of the job of the case. Questions? Sorry I couldn't just tell you. I mean, I was hoping it was a more general question. Okay, now I have not much time between now and the end of this course, and I'm trying to figure out how to use this time. I asked you to prepare Camelback communications for this class. So I thought what we would do is take a look at Camelback communications just for a second. So I want to spend 5 or 10 minutes on Camelback just to give you the basic idea, and then we will bid adieu. Now, Camelback communications. Who has read it? Who can tell me about Camelback? What's the story in Camelback?
Camelback is a manufacturer of TV antennas and other sort of FM radio antennas and things like that. They have basically 4 product lines, and they're having difficulty allocating their costs between the 4 product lines.
Okay.
The production manager and the CEO seem to think that it's due to the way that they allocate their overhead costs.
Okay. So, what is their process? I cannot bring my. I'm having difficulty bringing my computer up here, and that's why I'm sitting here going, "Oh no! Great way to end your class. Something I can't do." There we go. That's not good. Get closer. I apologize. Okay. Do a quick review of what's going on. If you come to the graphic, please. Can everyone see that? This is table number 1 in this particular case, Camelback case. And what's going on is we know the actual cost of the product. So we know the true cost of the product. And the true cost of the product is if the direct materials for A are 15, direct labor for A is 30, variable overhead for A is 15, total variable cost is 60, fixed cost is 10,000 for A. We produce 1,000 units of A, therefore the average fixed cost is 10,000 divided by 1,000, which is $10 per unit. Does that make sense, everybody? Now, what then happens is this firm starts doing an analysis, and what they do is they allocate, right? Now you know truth, which you never actually know. right? So table number 1 is truth, which you never ever know at a corporation because you never know how much it costs. So what this firm does is it then says, okay, we never saw table 1, so we're going to allocate overhead. And they go to allocate overhead, and what they then allocate is they take variable overhead, which is $35,000. And where did the $35,000 come from again? Go up to our table up here. Variable overhead is the $15 of product A times how many units? 1,000 units, plus 750 times 1,000, plus 5 times 1,000, plus 750 times 1,000. So you multiply total number of units by total amount of variable overhead per unit, you get the amount of variable overhead. Fixed overhead is 20,000 from A and B, 25,000 from C and D. Add them together, get $80,000 of total overhead. That's the big blob, at $80,000. Then divide through by total number of labor hours, which is 12,000. And that should not be a dollar sign, right? That should be 12,000 units. Where's 12,000 units come from? In terms of this example.
Labor hours per unit times the number of units.
Labor hours per unit times the number of units. Which product has the largest number of labor hours?
First,
A has the largest number of labor hours. How many labor hours does A use? $30, but 6 labor hours, right? Does that make sense, everybody? So then we take total labor hours, which is 12,000, divide into our total overhead cost to get our application rate per direct labor hour. Does that make sense, everybody? What does the company do next? The company then allocates this stuff to get their standard cost. They know direct material is $15. They know direct labor is $30. Then they allocate overhead. Now, where does $40 come from again?
6 hours times the allocated.
6 hours times, what's the allocation rate per hour? 667, right? Because it's $40 of standard cost due to overhead, plus the other 45, total standard cost 85. Does that make sense, everybody?
Under the labor hours, why do they have 60,000 divided by 5? $7,000 divided by 5 equals...
It's $5 per hour.
I think it's $5 per hour.
Oh, okay.
Right, so that's therefore 12,000 labor hours. Everybody with me so far? And all I'm doing now is reviewing what was in the case. Right? We haven't done any analysis. All I'm doing is reviewing what the case. These are all tables directly from the case. This is table 4, obviously. Now, so what goes on is that true price in the market is you take the true cost, which is $70 per this particular product, at a markup of 28%, or at a markup of 40%, 4 times 7 is 28. So the cost in the market, again, if we believe table 1 is accurate, then the cost, then the price in the market will be $98. Does that make sense? Now, for this particular, well, we need some way to figure out what the price in the market is, right? And the price in the market is we take the true cost of production, which is $70. Now, where does $70 come from? From table 1, right? Which is $60 of variable cost and $10 of fixed overhead cost, $70 total. That's truth. No one ever knows that, but that's truth in this case. Add a 40% markup, total 98. Now the problem is that the selling price is 98. Our standard costs are how much? 85. That gives us a profit of $13 per unit, which gives us a profit percent of how much? $13 on either 85 or 98. What is that? what is this? B63 divided by B62 on our cost, right? And what do we require to keep producing this item?
25%.
We require a 25% return at least to continue producing this product. So what do? We get rid of this product. Does that make sense? Now let's go back to the beginning and remember what we just talked about. How do we allocate cost in this particular example? Based on what?
Labor hours.
Based on direct labor hours. Which product has the most direct labor hours? Product A. Therefore, which product is relatively the most expensive? A. Which product uses relatively the second highest amount of direct labor hours? C. So what we just did was we just eliminated product A because it didn't meet our profit expectations, right? It cost too much. Now we go back and we reallocate this crap. Which product is going to be the most expensive? Product C. What are we going to do? We're going to eliminate C. Does that make sense, everybody? So as simple as it may sound, when you look at people's firms' cost systems, the first question you want to ask yourself is, okay, if they're using this particular cost driver to allocate costs, then the next question is, what products use relatively more of that cost driver? Because those products necessarily are going to have relatively more overhead costs attached to it. The next step is then, does that make sense? Does this cost driver in fact give you an accurate representation of the overhead cost that is in fact incurred? Questions about that? Well, that is the key insight to Camelback communication, and it's extremely simple, right? And the extremely simple insight is that if product A uses relatively more of the cost driver, it gets relatively more of the cost, and hence the cost is relatively more distorted if the system isn't accurate. Does that make sense, everybody? Now, if you choose, you can go through the rest of this example, and now hopefully you can work through exactly what's going on, because all you do is reallocate the costs that are remaining, and what you find is eventually they throw away all the products and they go out of business because of the distortion in the cost system. Because the way they allocated overhead relative to what was true caused them to make bad decisions along the way. And each bad decision then made it more difficult to make the next good decision. Does that make sense? Okay. Question?
Did they actually go out of business, or did they finally catch it?
This is an artificial case. They never know what costs are. Right? This is a. I think it's a good case because it lets us see exactly how cost systems can distort what's going on, but it's pure fiction. Question.
Question number 4 at the end asked what would happen if they decided to keep their cost system but decided to maximize contribution. What do they mean by maximize contribution?
What's contribution? You tell me.
The contribution margin?
Yeah.
Isn't that essentially what they're doing by trying to maximize the markup?
No. It gives you a different decision-making product. If you maximize, again, if you come to the computer screen, question number 4, if you maximize margin, right, then remember A got relatively more of the overhead cost, right? We pull the overhead cost out, and now we look at just the contribution margin. A's contribution margin is relatively larger, right, compared to B. And so what happens is between A and B, you drop B and keep A, based on contribution margin alone, ignoring fixed costs, right? So it gives you a different accept-reject decision rule. It still distorts the truth in the end, and you end up making bad decisions, right? It just does it in a different way.
Okay.
Mind?
Yeah.
Answer your questions? Okay. Okay, if you come off the screen, please. So last time you had with me, what questions do you have? You got a couple more minutes. How can I help you? As far as I'm concerned, the course is over. Wahoo! It's done. What can I do for you? So 10 questions in the final. All right? You have 3 hours to do the final. I gave.
What chapters did you go up to? Sorry, it didn't seem like we hit on that chapter. So.
Okay, we did not do chapters 40 or 41. But I go over everything up to chapter 39. We did bits and pieces of everything up to chapter 39, except for budgeting, but we did that in financial accounting. So, everything, I'd review everything up to 39, but ignore 40 and 41. Any questions? Well, it's been my pleasure to hopefully lead a little bit and have some fun with you. Good luck in the exam, and we'll try to get you the grades as soon as we can. Thank you very much. Go beyond the wire.